Welcome. Today we are looking into one of the most fundamental topics in all of investing: stock market indexes. Understanding indexes is the key to understanding how the entire stock market works. This video is going to change how you see markets forever. A stock market index is a measurement tool that shows how investors feel an economy is faring. It collects data from many companies across industries to show overall market performance at a glance. It tracks performance, groups, stocks, and covers different market segments. There are 4 major indexes you must know. The DJIA is the oldest, tracking 30 companies. The S&P 500 is the gold standard for measuring the broad market. The Nasdaq Composite focuses on technology and growth. The Russell 2000 tracks small-cap stocks. The Dow Jones Industrial Average is the oldest index, created in 1896, and tracks just 30 influential U.S. companies. It uses a price-weighted methodology, meaning a higher stock price equals more influence, regardless of company size. The S&P 500 is the market benchmark, tracking 500 large U.S. companies across 11 sectors. It is market cap weighted, meaning larger companies like Apple and Microsoft dominate. It represents about 80% of the total U.S. market value. The Nasdaq Composite tracks around 3,000 stocks, heavily focused on technology and growth companies, making it more volatile. The Russell 2000 tracks 2,000 small-cap stocks. It is more volatile, but historically offers strong long-term outperformance potential. Beyond the Big Four, you should know the Nasdaq 100, which tracks the top 100 non-financial tech stocks. The Russell 3000 covers nearly the entire U.S. stock market. Other key indexes track mid-cap, small-cap, value, and growth stocks. This slide might be the most practical thing in this entire video, because this is where a lot of people make a really costly mistake. Every day you'll hear things like, the Dow dropped 400 points today, or the S&P 500 gained 50 points, and people panic or celebrate based on those numbers. But here's the truth. Point movements mean nothing without context. Let me give you a real example. Imagine the Dow is sitting at 40,000 points, and it drops 400 points. That's a 1% decline. Pretty normal market movement. Now imagine a smaller index sitting at 500 points, drops 20 points. That's a 4% decline. Actually quite significant. But 20 sounds much smaller than 400, right? This is why you always focus on percentage changes, not points, percentages. Now, step 1 when reading any index, find out its baseline starting value. Every index began with an arbitrary number on its first day. The S&P 500 started at 10. Today it's over 5,000. That journey from 10 to 5,000 is the real story. Step 2, look at the direction. Is it up or down today? Step 3, calculate the percentage. Step 4, and this is underrated, know what is in the index. The Nasdaq goes up because tech is doing well. The Russell 2000 goes up because small companies are thriving. Understanding the components tells you why the market moved, not just that it moved. Okay, this is the slide that separates people who understand indexes from people who just know about them. Let's talk about weighting, how much influence each stock has on an index. Method 1, price weighted. This is the Dow's method. Simple idea. The higher the stock price, the more influence it has. If stock A is $500 and stock B is $100, stock A has 5x more impact on the index. Here's the problem. Stock price alone tells you nothing about how big or important a company is. A company can do a stock split and suddenly have half the influence it had yesterday, even though nothing about the actual business changed. It's an old school method, and most analysts today think it's a bit outdated. Method 2, market cap weighted. This is used by the S&P 500, the Nasdaq, and most modern indexes. Here, weight is based on total market value. That's share price, multiplied by number of shares outstanding. Apple, with a $3 trillion market cap, has enormous weight. A smaller company with a $50 billion market cap has far less. This makes more logical sense. Bigger companies have more economic impact, so they should drive the index more. Method 3, equal weighted. Every single stock gets the same weight. Apple equals the smallest company in the index. This sounds fair and democratic, and it does give you more exposure to smaller companies. But it requires constant rebalancing as prices shift, and it behaves very differently from the standard S&P 500. Most ETFs you'll buy track market cap weighted indexes. That's the dominant standard today. Look at this chart on screen. This is a really powerful visual. We're comparing the number of stocks in each major index, and it tells you a lot about what each one is trying to do. The Dow Jones 30 stocks, super concentrated. Every single company in there is a mega cap household name. When one stock sneezes, the Dow catches a cold. The S&P 500 to 500 stocks. Great broad exposure to large cap America. This is your bread and butter market benchmark. The Nasdaq 100 to 100 stocks. It's selective. Just the biggest tech and growth names on Nasdaq. High conviction, high concentration. S&P MidCap 400 to 400 stocks of mid-sized companies. Often overlooked, but historically solid performers. S&P SmallCap 600 to 600 small-cap companies. A bit more selective than the Russell 2000, with a profitability filter. Russell 2000 to 2000 stocks. The broadest small-cap index there is. If small businesses are thriving, this number goes up. And Russell 3000 stocks. The closest thing to tracking the entire US stock market in one index. Key insight. The more stocks in an index, the more diversified, and the more it behaves like the market as a whole, which for most long-term investors is exactly the goal. Alright, so now you understand what indexes are and how they work. But let me show you the 6 most powerful ways to actually use this knowledge in your investing life. Use number 1. Gauge market health. Every morning, check the S&P 500 and the Dow. Are they up, down? By how much? This gives you an instant health reading on the overall market before you look at a single individual stock. Use number 2. Spot sector trends. If the Nasdaq is up 2% but the Russell 2000 is flat, that tells you tech is leading and small businesses aren't participating. That kind of intel is gold for understanding where the economy is strong. Use number 3. Index fund investing. This is the life-changing use. Instead of researching and picking individual stocks, which is hard and time-consuming, you buy a fund that simply mirrors an index. Instant diversification, low fees, consistent long-term returns. This is what Warren Buffett recommends for most people. Use number 4. Benchmark your portfolio. If your portfolio returned 12% last year, great. But if the S&P 500 returned 20%, you actually underperformed. Indexes keep your ego in check and your strategy honest. Use number 5. Tailor your exposure precisely. Want only value stocks? Buy the S&P 500 Value ETF. Want small cap growth? Buy the Russell 2000 ETF. Indexes let you be surgical about your investing strategy. Use number 6. Educate yourself for free. Watching indexes daily, reading about why they moved, connecting events to market reactions. This is the best investing education available, and it costs nothing. The S&P 500 Value Index tracks mature, slower-growing companies, which are less volatile. The S&P 500 Growth Index tracks fast-growing companies that are more volatile. Smart investors often include both growth and value stocks. I love this slide because it makes the US stock market feel like something you can actually visualize and understand, like a pyramid. At the top of the pyramid, large-cap companies. These are companies worth more than $10 billion. The Titans: Apple, Microsoft, Johnson & Johnson, Procter & Gamble. The S&P 500 is where these live. These companies are stable, globally recognized, and generally move more slowly than smaller stocks. Lower volatility, consistent performance, the anchors of any long-term portfolio. In the middle, mid-cap companies, worth between $2 billion and $10 billion, tracked by the S&P MidCap 400. These are companies that have moved past the risky startup phase, but still have real room to grow. Many investors call this the sweet spot. You get relative stability and meaningful growth potential. At the base, small-cap companies, worth between $300 million and $2 billion. The S&P SmallCap 600 and the Russell 2000 cover these. Smaller companies, more volatile, but historically, over long periods, they can deliver the best returns of all 3 tiers. And here's the cool part. Put all 3 together, S&P 500, plus MidCap 400, plus SmallCap 600, and you get the S&P 1500 Composite. That's one index covering the entire investable US stock market, from the smallest qualifying company to the biggest. Alright, this is the slide you've been waiting for. All that theory. Let's turn it into action. Here is the exact 5-step process for investing using stock market indexes. Step 1. Choose your index. Ask yourself, what do I want to own? If you want broad US market exposure, go S&P 500. If you believe in small companies, go Russell 2000. If you love tech and growth, go Nasdaq 100. This choice defines your strategy. Step 2. Find an ETF or index fund that tracks it. For the S&P 500, you've got VOO from Vanguard, IVV from iShares, and SPY from State Street. All legendary, all ultra low cost. For the Nasdaq 100, there's QQQ. For the Russell 2000, there's IWM. Compare expense ratios, the annual fee, and go as low as possible. Even 0.5% difference in fees compounds into thousands of dollars over decades. Step 3. Open a brokerage account. In the US, Fidelity, Schwab, and Vanguard are excellent choices. Many offer zero commissions, no account minimums, and fractional shares, meaning you can start investing with as little as $1. Step 4. Invest regularly, using dollar cost averaging. Don't try to time the market. Nobody can do that consistently. Instead, invest a fixed amount, say $200 or $500, on the same date every month. When markets are down, your money buys more shares. When markets are up, you still keep building. It smooths out volatility beautifully. Step 5. And this is the hardest one. Stay the course. Markets will crash. They always do. The investors who win are not the ones who are the smartest. They're the ones who stay calm and stay invested, while everyone else panics. In summary, indexes are essential tools for comparison. Remember the big four, and always use percentages, not points. Weighting matters, and index funds make matching market performance easy and affordable for any investor. Now that you understand stock market indexes, you are equipped to make smarter investing decisions. Check out our resources for more investing basics, and keep building that financial knowledge together.